So this chapter primarily is a calculation oriented chapter. So the remaining two which are before this, they are basically theory based chapters. So not too much of connectivity between them. So that's where first we'll take up the calculation oriented ones, and towards the end we'll look at these theory based chapters, the other two, once we are done with this chapter. So whenever we are talking about the word valuation, the only thing we are trying to come out with is intrinsic value, the true value, the inherent value of that security. How do I get the inherent value? Based on its performance, based on various aspects of that particular security, we are trying to find out what is that true value. But that true value is always different from market value. Market value is what is available for. The true value is the inherent value, which each one of us will evaluate it differently. Right? Based on how we feel or how we perceive about the performance of the company, I'll associate an inherent value to it. The same thing applies to everyone. Right? A person, two people, or one person applying for two jobs. Right? One company is willing to pay a higher salary for the same person, whereas the second company is not willing to pay that much salary. Where is the difference? So the company A thinks he is worth only for this much, whereas company B is thinking he is worth for this much. So they are ready to pay more for him. So intrinsic value is always what is the inherent value based on assessment of different people, whereas the market value is something which is uniform, which is the only one price that is available. Some people may perceive that is more, some people may perceive that it is less. So that is where we have the definitions of overvalued versus undervalued. So if the market value is more than the intrinsic value, we associate it to overvalued or overpriced. Otherwise, we take it as undervalued or underpriced. So the buy sell decision also happens accordingly. If it is undervalued, I get into a buy decision. Overvalued, I get into a sell decision. But what typically happens is the market price, it should come closer to the intrinsic value. Right? Otherwise, there would always be this buy sell decisions happening until the market price approaches the intrinsic value. So if you think that your market price is more sell decisions will happen, which will bring down the price at least to the level of intrinsic value. So now, how are we computing that intrinsic value is the exercise of valuation. So from that standpoint, we have many different models of valuation. The first category of the models we talk of are DCF models, discounted cash flow models, which is nothing but all the future cash flows you estimate, just like we have done in our NPV IRR calculation. You estimate all the future cash flows of that company. How do I estimate the future cash flows? I know how to make a cash flow statement. Right? I estimate the future cash flows of the company, discount them to the present value at the cost of equity of that company. How do I find out cost of equity? We know it. The CAPM model. I find out the cost of equity. So discount all the future cash flows based on the cost of equity to the current value, which is nothing but find the NPV. NPV of all the future cash flows where the discount rate is cost of equity. So whatever the value that comes, that is what we are calling as the value of this particular security. So here the two different models that are being used as DCFs. One is dividend discounting model. The other one is free cash flow discounting model. What is this? Because the future cash flows, the company is expecting, let's say we are talking of equity investment. I have invested in a particular company. What is the cash flow I am going to get? Only dividend. Forget about selling off. As long as I hold it, the only cash flow that I can get from the company is dividend. Right? So assume that I am investing today. From an investor standpoint, the only benefit he is getting out of his investment is the dividend only until he sells off the share. So, depending on when we are getting how much dividend, so it's a mechanism of estimating the dividend. So, the cash flow in this example is nothing but dividend. How much dividend I am going to get at the end of each of the years. Those are my future cash flows. Discount them at the present value, at the cost of equity. Whatever I am going to get is what should be the intrinsic value of the share. If it is more, I give a sell decision. If it is less, if the market price is less, I'll give a buy decision. Fine. Similarly, in some companies' case, dividend may not be stable. In some years, they give more dividend. In some years, they don't give dividend. So, the dividend pattern is not stable. So, from that standpoint, if that is the scenario, we look at this free cash flow of the firm. What is the way we compute the free cash flow? We have looked at in our cash flow chapter. The free cash flow for the firm is nothing but cash flow from operations minus the capital expenditure. What is this indicating? Whether the company pays a dividend or not, what is the cash that is available with the company to pay the dividend? Whether it pays it or not is a secondary issue. But how much cash is really available with the company to pay the dividend? So, instead of looking at the real payment of dividend, free cash flow targets at real potential to pay dividend. Right? So, like how much dividend can they pay? Depending on whether they are paying or not is immaterial. Because whether to pay dividend or not, or how much dividend to pay, is completely a company management decision. Whereas how much is really available to pay is not a decision of anyone, is the reality. So that's where today in dividend discount, in the DCF models, the free cash flow means discounted cash flow. So the word which is used as a cash flow in DCF for equity valuation purpose is free cash flow. Right? When we say discounted cash flow, the cash flow which we are talking of in most of the cases is free cash flow. Earlier it used to be dividend. Right? So, in these two methods, the mechanism is the future cash flows, discount them to the present value based on the cost of equity, and whatever the number that comes out is what we are calling as the value of that particular equity. That's one type of models. Then we have multiplier kind of models, which are your valuation ratios, which we have looked at in our FRA. P by E ratio, P by BV, P by S, P by CF. These four are the ratios from where I can find out the P. Right? From where I can find out the price. Based on the industry comparison, I can very well say what should be the price of this particular security. How much is it really worth for? So, without looking at any performance or anything, I am assigning a value to the firm on a comparative basis by comparing these kind of ratios. These are the multiplier based models. Or even one of the multiplier based models are enterprise value by EBITDA model, which is also one more ratio only. We'll look at these terms slightly later. How do I arrive at the enterprise value? EBITDA anyhow we know, right? Profit before earnings, interest, depreciation, tax. So that is the EBITDA, but enterprise value is a slightly different definition. We'll look at it. And again, just like the way I'm using PV to find the price, I'll also use enterprise value also to arrive at the price. Then the third category of models that are typically used are asset-based valuation model, which is nothing but find the total market value of the assets minus the value of whatever liabilities I have, which will say this is the value of the firm. Again, I will not look at the equity here. Only the market value of all the assets which I am holding minus whatever liabilities I have. That is what is the value of this firm. Especially it is applicable to companies like SIC units, right? Where which is not generating any operations much and all. What I am actually buying out is what is there in the firm. What are the various assets the company is having? What is the market value of each of those assets? Whatever the liabilities they have, the net is what I am going to pay them. So these are the three types of valuation models which we have. Out of that, the first and second are very popular in the investor community. The second one is even more popular even in the broker community also, because you just need to know the 3-4 ratios, and based on that you are able to project the price. So even a normal broker, he observes these numbers and gives the decisions of buy or sell. Whereas the first one is what is the real work which a CFAs and all these equity valuation guys are more focused upon. Valuation modeling, financial models and all are built primarily from the first standpoint. Now out of that, discounted cash flows, whatever it is, whether I am using the dividend or free cash flow, the mechanism is the same, right? The book talks about 100 formulas. There's no point in remembering all those 100 formulas. Simple thing is, try to understand how much cash at what point in time. What is the dividend that is going to be declared at what points in time? What is the free cash flow at what points in time? Discount them to the present value using your calculators. That's it. So in this, they even talk about one-step model, two-stage model, three-stage model. All of them are one and same. Only just to fill the pages, you have so many stages. At the end, the concept is one and the same. Because we use a calculator, not formulas. We have the NPV as a formula in our calculators. So at the end, all I require is what are the cash flows at each of the period, discount them to the present value, and that is what will be the value of the firm. So if the dividends are given, find out all future dividends, discount them to the present value. If free cash flows are given, all future cash flows, discount them to the present value. That's the value of the equity of the firm. So whether I am using a free cash flow or dividend, the process is the same. Look at all the future cash flows, discount them to the present value. Right? So based on that, we'll try to solve a few numericals which will give us the complete hold on this. Calculate the value of the stock that paid one dividend last year, $1 dividend last year. Next year's dividend will be 5% higher and stock will sell for 13.45 at the year end. Required rate of return is 13.2%. Now how do I find out the value? What are the cash flows here? Sorry? We need only future cash flows. Okay, at t equal to 1, what are the cash flows? Dividend is 1.05 and I am selling the share also. This is what is the cash flow after 1 year. And this is because I am selling after 1 year, there is nothing beyond that. I am disposing after 1 year. So this 14.5 is the cash flow after 1 year. Now what is the present value of that? I can find out. So you can use PV formula. Or you can simply use PV in your calculator. 14.5 is the FV, right? What other numbers? 13.2% is your interest rate, which is I by Y, 1 year. N is equal to 1. Based on that, you can do a compute PV. So I said 12.81. So all it is saying is the intrinsic value of this stock is 12.81. So if in the market right now it is available for less than 12.81, I'll buy it. If it is available for more than 12.81, I will sell it. Right? Okay, now what about the second one? So T equal to 0, 1, 2. What are the dividends? 5% increase into 1.05. So this is the dividend here, and this is the dividend here. 5% increase every year. And what is the sale price? After 2 years, I am selling at 14.12. Right? And what is the 13.2%? So based on this, I can find out all the future cash flows I want to find out. What are the future cash flows here after the first year? I am having a future cash flow of 1.05, and after the second year it is going to be 15.22. So I can discount these two to the present value. So when I have to do two different cash flows to the present value, NPV is a better formula. So I am using NPV at 13.2%. The interest rate is 13.2%, and my cash flows are these two. These two are my future cash flows, which is resulting again in 12.81. So today, if this is what is expected about the share after 2 years, so that it will give me a dividend of 5% more compared to the last year every year, and I am assuming that its share price will go to 14.12 after 2 years. If those are the situations, then it is worth to buy the share at 12.81 according to me. Now here, these are all estimates only. You may think different, I may think different. Because we are talking on numericals, all are thinking the same. But in real world, all are estimates only. So your estimate will be different from my estimate, which means the present value will be different because all these numbers are different for each one of us. Because we are talking of numericals here, we will get the same and answers have to come to be the same. But real world, all three will be different for all of us. Right? Yeah. Look at the next one. How do I find value of the preference stock? Sorry? Cost of preferred stock. Go back to your Preference dividend divided by the price. Now I can find out the price by preference dividend divided by the cost of preference stock. So preference dividend is 5, cost of preference stock is 0.08. So the price should be around $62.5. So if it is preference stock, it's a probably in our cost of capital chapter we had this. Cost of preference stock is nothing but the preference dividend divided by the price of the preference share. Now we are asking the price of the preference share only. So with small adjustment we can very well compute the preference dividend divided by the cost of preference share. Cost of preference share he has given as 8%. So you can find out the value of the preference shares. Yeah, this is where now when we are talking of equity, as I said, the only thing we have to use as a part of our equity is it's better to go through few numericals. That's the easier way to understand all our questions. Even this sustainable growth rate also we have looked at as a formula. How do I find sustainable growth rate? ROE into RE. In our again cost of equity calculations we have done that. In cost of equity dividend model D1 by KE plus G. That G is obtained through ROE into the retention rate. So ROE into retention rate. Now in this case what would be the numbers? Expected to pay dividends equal to 25%. So the retention rate is 75%. Dividends are paid as 25%. So the retention rate is 75%. Okay, RR is 0.75. ROE is 21%. I can very well find out whatever is the growth rate. Right, 21% into 0.75 will be your sustainable growth rate for the firm. And if at all I have to find out cost of equity, D1 by P naught plus G. G is this one, this value. Right. Okay. Now the next question is a very important question for us. No, look at the last question first. Then let's go back to the next one. This one. Or before this, let me give one more slightly simpler question. Then I think we should apply this question. The last paid dividend is $1. Dividend is last paid dividend is $1. Dividends are expected to grow at 5% per year forever. Not for 1 year, 2 years. Infinite growth. Because equity is assumed to exist forever. So I am assuming that every year dividend will grow at 5%. Now, and take cost of equity as some 12%. So what should be the value of this stock? Getting it? What should be the value of this stock? Now, what is the formula we talked about value of a stock? Present value of all the future dividends. What are all the future dividends here? Okay, let's talk about 0, 1, 2, blah, blah, blah. Because we are talking of infinite. So 0 is 1. In the first year, the last paid dividend is 1, which is the current year dividend is 1. Now if I am talking of next period, the dividend is increased by 5%. The next year it is again increased by 1.5%. The next year it is even increased by 1.5 by 5%. So how long will we put it? Up to 20, 50, 100, whatever it is. What we need to understand here is from wherever, from whichever year, there is a constant growth. This is what is typically called as a constant growth model. From whichever year, there is a constant growth. From which year there is a constant growth in this example? From first year. From first year, whatever is the percentage, second year is also the same, third year is also the same. So for this entire period, the growth percentage is constant. From whatever year the growth percentage is constant, you always take one period before that. From whatever year the growth percentage is constant, from the first year onwards, the growth percentage, here it is 5%, here it is 5%. From whatever year the growth percentage is constant, and for infinite, not just constant, for infinite. Right? Equity always works on the fund of infinite because it's a forever existence. Right? That going concern is the assumption of any equity investment. Any valuation works on the principle of infinite existence. So from whichever year, we are assuming that the growth rate is constant. The year before that, the value of all the future. So from as of this year, the value of all these things up to infinite actually follows a mathematical principle which is geometric progression. So the sum of all these terms up to infinite goes very simply as the next period value which is D1, whatever, if I am looking at it as D0, the next period value divided by KE minus G. That is what is the value of all the things from first year to infinite year. From wherever there is an infinite growth, constant growth for an infinite period. That G is that infinite period growth. So in this case, what can it be? 1.05 divided by KE in my case is 12% minus G is 5%. So the value of all those benefits is somewhere around 50. So which means the value of this share should be around $15. The intrinsic value of this share is $15. Lesser than $15 in the market, I will buy it. Greater than $15 in the market, I will sell it. So from wherever, the only reason why I took this example is, in most of the questions, we'll observe the scenario. From this period onwards, the growth rate is this much for an infinite period. So what will you do is, from this period onwards, when he is saying a period before that, the value of that, of all these future, the present value of all these future as on that date is a simple formula. Whatever is the cash flow of the next period divided by KE minus G. KE is the cost of equity which would be given. G is also a growth rate which is given, which is nothing but this is actually a reversal of our formula D1 by KE plus G. Cost of equity equal to D1 by KE plus G. You reverse it, you will get G, you will get P naught is nothing but D1 by KE minus G only. The same formula you do an alteration, you will get as D1 by KE minus G itself, which is what is typically called as a constant growth formula, which will typically be taken only in case there is a constant growth forever. from that point where there is a constant growth. Fine. Now, using that information, you try doing this numerical. You will get a very good understanding on this model. Forget about multi-stage growth, blah, blah, blah. All the valuations are one and the same only. So, with different models, you will not get different formulas. You just need to understand what are the cash flows that are coming at what point in time. For 4 years, there is a 20% growth. And from 5th year onward, there is a 5% growth forever. Those are the cash flows. Okay, let me put those cash flows here. So, because there is a difference for the first 4 years, probably I will take only up to this. Because from 5th year onward, there is infinite. So, I just need 1 or 2 periods of infinite. Okay, here it is $1. Then it is growing at 20%. So, I will make it multiply by 1.2. Again, this one is also growing at 20% in the second year. In the third year also there is a growth of 20%. In the fourth year also there is a growth of 20%. In the fifth year there is a growth of 5%. In the sixth year there is a growth of 5%. Doesn't matter. At least 1 year of fifth year. So I know that from here onwards there is a constant growth forever. Getting this? If you know this scenario, the whole problems are addressed very simply using your calculator. From where is the infinite period growth? So from 5th year onwards, there is an infinite period growth and that too at a constant rate. So you come down here, 1 period before that. Use that formula, D1 by KE minus G. What is the D1 for us here? This is the D1, the next period dividend or next period cash flow, whatever it is. Whether it is free cash flow or dividend, the process is one and the same. So D1, what is our KE in this case? He did not give it. 10%. He has given the KE as 10%. So D1 by KE minus what is the growth rate here? 5%. It's growing at a constant rate forever for 5%. So this is 43. So 43 is the value of all these things up to infinite. But I need to find out the present value of all these things also. And even this is as of 4th year, even this is as of 4th year. So add these two 4th years. Because they are of the same time period, I can plainly add them. So adding these two is giving me 45 point something. Whereas here for each of these years, this is still 1.2. This is still 1.44. Whereas this is still 1.728. These are the 4 cash flows for 4 years. Now you can find out the present value of all of them, NPV, discounting it at 10%. So I will find NPV at 10% for these 4 cash flows. For these 4 cash flows, the NPV is coming out to 34.74. So I am saying the worth of this particular share is, the intrinsic value of this particular share is $34.74. Available for cheaper than this, I am going to buy it. Available for costlier than this, I am not going to buy it. Or I am going to sell it. Right? Whatever is the formula, you don't need to mug up the formula anywhere because question can be tweaked in whatever way he wants. So the easiest way to do these kind of questions is find out what are the dividends in each of the years. From which year it's a constant dividend. Just the one period before that, apply the formula D1 by KE minus G. So that is the value as on one period before, the sum of all the next few periods. All the periods up to infinite. So that's the summary as of fourth period. From fifth to infinite, whatever are the future cash flows, the sum total of all of them as of fourth year, one period before, is this much. So, but for fourth year, there is a separate value. These two add up. First year, this is the case. Second year, this is. Third year, this is. Fourth year is the combination of these two. Then you find the NPV, which will give you the price at which this stock is worth. Fine. Do look at the question slightly above it. Okay, now what is the scenario? The same logic let's apply. They did not pay any dividend. 0 year, 1 year, 2 year, 3 year, 4 year, 5 year, let's say. 0th year, no dividend. I mean, we are not bothered about 0th year because we need only future payment. First year, no dividend. Second year, no dividend. Third year, no dividend. Fourth year, what is the dividend? The earnings are 1.64 and the payout ratio of 50%. 0.82. 50% of 1.64 is the dividend. Okay, so the dividend, the payout ratio in this case is, or dividend in this case is 0.82. And we are talking of that it will grow at 5%. So whatever is the number, it will be growing at 5%. But I know that from this period, there is a constant growth. From this period onward, there is a constant growth. So which means here I can find out the value of all the future. What is the value? The next period dividend, which is this one, divided by KE. Did he give any KE? He has to give 10% and growth is 5%. So I am saying 10% minus 5%. So which is coming out to 17.22. Now, because these two are the different numbers for this period, I'll add them up because this is as of fourth year. This is the summary from fifth year to infinite year viewed from fourth year as of fourth year. So because these are two things as of fourth year, I am simply summarizing these two, which will give me this number. And of course, the remaining all years are zeros. So for these four items, I'll find out the NPV at the 10% rate of interest. So which is telling me 12.32. So the value of this share according to me is $12.32. Anything available for more, I'll sell it. That's a overvalued versus undervalued kind of a decision. So all calculations that are associated with the DCF, they work in the same manner. Though you should be good at identifying when each of this, what are all the cash flows that are there and at what points in time they are coming. And after that, your usage of time value of monies or NPV kind of formulas that matter. But the only thing is, from wherever there is an infinite period growth, I can summarize all those things using one single value, because that is also nothing. That's also, you are doing it as the present values only. But for an infinite period, there is a concept in geometric progression, the sum of infinite terms of a geometric progression. It follows the geometric progression and there is sum of infinite terms of a geometric progression, which will work out to this formula, the next value divided by KE minus G. So we are directly using that formula. From wherever there is an infinite growth, one period before that, I am summarizing all those things by using d1 by ke minus g. Right? From wherever there is a constant growth rate for infinite period. Sometimes he may say the company is growing at a constant rate of 10% for 4 years. Whenever he says for 4 years, you cannot use that formula. I have to manually do a 20% growth or 10% growth for 4 years. Manually, I have to put the numbers. But from there onwards, at 5% for infinite, only at that point I can use this formula. Right? So you just write down the numbers for those 3-4 years, which are not for infinite, and from wherever the data is about infinite, you simply take the present value using the formula d1 by ke minus g. Right? So this is on any kind of discountings which we have. DCF formula means this is the only formula. Right? They make 20 pages or 30 pages in the book only talking about 2-stage growth, 3-stage growth, 20-stage growth. It's least bothered for us when we are using calculators. All I have to know is what are the, because the formula will be more than a line longer and we don't get any kind of help with respect to the formulas in the exam. So there is no point in remembering the formulas because the question can be twisted also. So there is no point in remembering the formula. Always remember it as all cash flows. The only formula you should remember is d1 by ke minus g from wherever there is a scope of infinite growth. Okay, now the next set of ratios which we are looking at is the multiples based, or the next model of valuation which we are looking at is the multiples based, which is the P by E ratio. Now, if I have to slightly modify P by E, just now I have found out the value of P, d1 by ke minus g. Correct? What should be the price? Intrinsic value. Intrinsic value I have got through this formula d1 by ke minus g from wherever there is a infinite growth. So in place of P I will write this. In place of E I will keep E like this. Take the E to the numerator. So I can very well write it as d1 by E divided by ke minus g. What is d1 by E? It's a dividend payout ratio. E is the profits, D is the dividend. E is the earnings, D is the dividend. Dividend as a proportion of the earnings, which is nothing but the dividend payout ratio. Right? How much of my profits I am paying as dividend. So it is nothing but payout ratio of the company divided by ke minus g. This is what is the formula that you can assign to the P by E ratio. And as we already discussed there, the higher the P by E, there is a possibility of overvalue and the price has to come down because most of the people will sell it. Now here we are also looking at the same thing. If the P by E is more, which is nothing but if the, let's say if the organization has a target of increasing the P by E, how can it increase? Either payout can increase. If the numerator increases, P by E increases. If this one decreases, the P by E increases. If this one increases also, P by E increases. So either if the P by E has to increase, payout increase. This is one common question which we observe. Payout is increasing. KE should decrease and G should increase. If this is happening, your P by E ratio will increase. So if you want to decrease, you do the reverse. So he'll say which of the following are required to increase your PE, or which of the following will result in an increase in the PE. So based on this, one of them, two of them, he gives increase, decrease. So it's just nothing but this equation. If I can say P by E is nothing but payout by KE minus G, I can decide which of the things have to be increased or decreased to increase my P by E ratio. That's an intrinsic value. Just now we have computed the intrinsic value, right? Price. In an infinite growth, whenever the growth rate is infinite, I am finding out the price only through that, right? What is the to be price? See, I am not looking at actual price. I am looking at what is the justified P by E for this company. What is the to be price? If the actual P by E is more than that, I will look at selling off the share. If the actual P by E is less than that, I will look at buying the share. Underpriced, I will buy it. Otherwise, overpriced, I will think of selling it. So just like that, we use P by E, P by B, P by S, P by CF. In all of them, the commonality price is in the numerator. So if the price is a market price, see, there are two ways of defining the price. One is the market price, two is the intrinsic value. If the price is a market price in this case, the higher the value, the overpriced the security is. So if the P by E is higher compared to the competitors, overpriced. Because numerator, which is the market price, is higher. Right? Or similarly, P by S, market price is higher compared to the sales which it is doing. So compared to the competitors, if market wise P by E, P by S are higher, we say it is overvalued, better sell them off. If the P is a market price, if these ratios are lesser, they indicate underprice, go for a buy. But if I am looking at P as an intrinsic value, the higher is the ratio, the higher should be the P by E. The higher should be the P by E because P should be higher. If P is higher only, the market price will be lesser than that, which could result in an undervaluation. If the valuation P is lesser, the market P is higher, it will result in an overvaluation. So look at these numbers again, it will give a clarity. Just now we have talked about the P by E ratio, payout by KE minus G. Payout ratio is 60%, KE is 11%, G is 5%. Based on that, I have found out, did I make any mistake? Payout, 0.6 by 6%, so this is 10. So, the price is 10 times that of the profit. When I am saying P by E for this company should be the maximum P by E or the allowable P by E for this company is 10. If it is more than 10, I'll say it is overvalued. If it is less than 10, I'll say it is undervalued. Because this is the justified. Based on its intrinsic value, this is the accepted P by E of this company. D1 payout by KE minus G. Payout is coming from the fundamentals, from the financial statements, KE minus G. So this is the accepted P by E of this company. Now if from the market price, if the P by E comes out to be 12, it is more than this 10, I'll say it is overvalued, get it disposed. The same way, if it is less than 10, I say it is undervalued, better buy the share. Now look at this industry here. Which of these this is what is the other example I was talking about. Which of these will result in a higher P by E for the company? For Holt, payout ratio is high. For this company Holt, payout ratio is high. When do we get a high P by E? Payout should be high. KE is lesser. Growth should be higher. When growth is higher, KE minus G will be lower. Denominator is lower, the ratio will be higher. So in this case, Holt is already having a higher payout. So that will result in a higher P by E for the company. Similarly, growth is higher. Growth is higher will result in the lesser KE minus G, which will result in a higher P by E for the company. But how does this contribute? Debt to equity ratio is higher. So the company is having a very heavy debt. If the company has a very heavy debt, the cost of equity will be more, because equity investors will look at it as a risk. If the debt compared to the equity is very high for a company, for an equity investor it's a risk. So cost of equity for the equity investor will be very high. He will be expecting a bigger return. So the cost of equity is higher. Cost of equity is higher will result in P by E ratio being pulled down. So that's where only the first and second factors are suggesting that this company will have a higher P by E, whereas the third one is suggesting that the company will have a lower P by E, or it will pull down the P by E ratio, which is actually increased by the first two factors. Right? So this kind of logical questions are very much expected on this particular topic. See, if the debt to equity is high, debt is higher compared to equity. So any company which is having a very high debt, it's a risky thing for an equity investor. Right? Debt is more than the equity. When debt is more than the equity investor looks at it as a big risk. So which means he is expecting a bigger return. Expecting a bigger return is nothing but cost of equity for the company is higher. Return on equity, what the investor is expecting is same as cost of equity from the company's side point. So the cost of equity will go up. So from our equation, KE is going up, will pull down your P by E ratio. See, when I go with a P by E from a market standpoint or industry comparison standpoint, all it says is this company is overvalued compared to this company. But overall, the industry itself could be overvalued. That is not being told by your comparison ratios. It only says this is better than this. That is not the same as both are good or both are bad. The whole industry itself could be overvalued. But in our comparison analysis, what is saying is this is slightly undervalued compared to this. But overall, all the companies in the industry would be overvalued itself or would be undervalued itself. So that definition is coming from your intrinsic value. What is the true worth of this company based on its performance? I am nowhere looking at in comparison with something else. In comparison is mostly like, okay, this person is better than this person. But both of them may be equally bad, both of them may be equally good. Only in that comparison angle, one is better than the other. So when I am purely looking at only comparison approach, that is the statement I am making. But when I am doing it with intrinsic value, I am looking at what is its true worth. Compared to its true worth, is it more hyped or less hyped? So now it's up to us. If you are primarily looking at from a very long term perspective, looking at it with the intrinsic value is much better. But if you are looking at a quick profit making kind of perspective, industry comparison is much better. Okay, as of now, this is overvalued. So better sell this, buy this. I make a quick gain on that. Again, this equations may turn around. Again, buy this, sell this. So that's the method of quick buy-sell process. Whenever I am directly looking at the market price. Okay, let's understand one thing. Whenever the comparisons are directly from market price to market price, that's always a part of your technical analysis. I mean, there is an involvement of technical analysis in that. But whenever I am comparing the fundamental from the performance to performance, then there is an intrinsic value or the fundamental analysis inside that. So now both are good approaches, but one is more from a short-term standpoint, one is more from a pretty long-term standpoint, medium to long-term kind of a standpoint. Right? The third dimension people look at is nowadays this is gaining a lot of momentum, a slightly extended version of P by E. An extended version of P by E is enterprise value by EBITDA. The reason being, P is profit, or which is the price. P is the market price per share. Now when I use enterprise value, it's not just the market price per share, it's even including the market price of the bond. So market price per share is nothing but market value of equity. But I am extending it to the company level. Market value of equity plus market value of debt. Right? That is what we call as an enterprise value. But out of that, people remove cash. Because cash is not company. Cash is a separate countable entity. So cash and any investment the company has made, which are investments are not in the company's core business, some other mutual funds and something else. They are not a part of the scope of the company. So whenever we define enterprise value, this is the value, especially when A wants to acquire B. They look at this word called enterprise value, which is nothing but the market value of the debt plus market value of equity minus cash minus investments the company has. Because investments are not a scope of the company. Right? If I want to buy you, I want to buy only you as your company. You might have invested in some mutual funds which I am not bothered about. Right? I will buy only the company. So that's where they have come up with the mechanism. Whatever cash you have, that's fine. I don't need to buy that cash. I mean, it's like I am paying to buy your cash. I already have my cash. Why should I pay you that much extra? Right? So whenever we talk about the enterprise value, this is the definition. The market value of debt plus market value of equity. And wherever I am not able to find out the market value, because some debt or bonds may not be traded heavily. So wherever I am not able to get the market value, I will take the book value itself. But wherever I can get the market value, I will take the market value of the debt. So market value of debt plus market value of equity minus cash minus investment, which is the whole value of the company. That is what we call as the enterprise value. So which is equivalent to the price. In a P by E ratio, price is only for equity, guys. The value of the equity itself. But when I say enterprise value, it's the value of the total firm. Similarly here, E is the earnings, which is the PAT, which is only the equity investors. After interest, PBT, everything is what we are calling as the interest, the earnings, right? The same thing when I extend it to the firm, it's nothing but EBITDA. Because I am talking of earnings before interest, depreciation, tax, everything. So a slightly improvised version, see when P by E is only talking about the equity investors ratio, the same as a fund level ratio firm level ratio is what is my EV by EBITDA ratio. But the interpretations are more or less the same. If this ratio is higher compared to my competitors, I'll say it is overvalued. Lower, I'll say it is undervalued. That interpretations will remain the same, right? Look at this numerical to compute your EV by EBITDA. Any queries on this? See, for long-term debt, we had book value as well as market value. So I'll use the market value. But total debt book value is given. So the book value of short-term debt is 1.5 million. But there is no definition about the market value of the short-term debt. So because it is not given, wherever the market value is not available, I'll take the book value. Because probably their long-term debt is traded, whereas their short-term debt is not traded in the market. If it is not traded, I may have to assume their book value itself as their market value. So that's where I am taking that remaining 1.5 million, whatever is the book value, that book value itself I am taking as a market value, which is what is giving me my total enterprise value as 11 million, because no investments are there here, right? So 11 million is the enterprise value. So if someone has to buy this firm, they have to pay 11 million for acquiring the whole firm. And EV by EBITDA ratio is 11 by 1.2, probably around 9 times or something. 9 times is the enterprise value more than the EBITDA of the company. So again, I'll compare it with the competitors and all, because the value which I am computing is the market based value. Market value of debt, market value of equity. So it is everything based on market price. So whenever it is at market price, I'll compare it with my competitors. If it is higher, I'll say it is overvalued. If it is lower, I'll say it is undervalued, and go for a purchase decision. Then the last type of valuations which we generally look at are the asset based valuations, especially when the company has acquired so many assets, but it has not started using them appropriately. So they have bought lot of buildings, but they have not utilized those buildings. So are some sick companies. They have so many assets, so many machines and all, but they are not able to generate business out of them. In those cases, if I go with the present value of the future cash flows will be very little for that company. So the intrinsic value will come very less compared to what the kind of assets they are holding. In those cases, compared to a DCF kind of a technique, the asset valuation model will be more appropriate, especially when the assets are very large, tangible kind of stuff. Let's say a company has purchased 20 aeroplanes. But operations wise, it's not able to do very good in operations. Now, if some other company has to purchase that firm, they cannot look at it from their DCF model because their profitability is very bad. So neither they can give dividends because their operations are not good. They have a lot of assets, but they don't know how to put it into good operation. In those cases, if A wants to purchase B, it is mostly the asset based valuation that is looked at. So the market value of all the assets minus the market value of whatever the liabilities the company has, that is what is going as the total worth of this company. If there are 20 planes, I'll try to find out the market value of all the 20 planes and whatever the debt or loan this company is having to pay for those 20 planes. The difference between the two is what I say is the worth of this company, and I am not buying the operations or business of the company. I am actually buying their assets, right? Because I may use it for different purpose, but I am valuing their assets. Oh, these planes are really great. I can use them for various purposes. The business I may generate is different using the planes compared to the business he is using for, right? Now that's where now if I do a small advantage versus disadvantage analysis, the DCF models, they are the most widely accepted in the analyst community. But it is very, though we say easy to calculate, only when templates are there, they are easy to calculate. Otherwise, so many assumptions are typically being made. Every number is an assumption into it. And assumptions change from person to person. All inputs into it are forecasts only. So the more we understand the business, the more we can forecast better. The more we can forecast, the more is the accuracy of the intrinsic value. Then accuracy of our decisions. Right? And compared to the dividend, free cash flow is the most chosen one because dividend is heavily limited by the company's decision whether how much dividend they want to pay. It's not guaranteed that the company, it's not mandatory for a company to pay a fixed amount of dividend. So because of that, free cash flow is more preferred compared to the actual payment of dividend. And infinite period growth, D1 by KE minus G, which is actually called as Gordon growth model. That constant growth model it's actually discovered by this guy Gordon, so it becomes a Gordon growth model. Typically when the firm is stable, because every year it will grow at a constant rate. So the firm has to be more stable. Probably our IT industries and all which fluctuate drastically, they cannot be covered under this model. Right? Probably if I assume that after 10 years they will be stable, then I will cover them. Okay, up to 10 years this is their growth. From the 11th year onward they will grow at this rate for a constant period. That's the way I do the valuation for industries which are very much fluctuating in their growths. Similarly, mature, non-cyclical kind of firms. Probably 2 years they do much better, another 2 years they do bad, or they are affected heavily by recession, but in a boom they do very good. If that's the case, we call them as cyclical kind of firm. In some periods they generate very heavy growth, in some periods they generate a very big fall, like our real estate industry and all. When the economy is booming, probably real estate is the one that grows much faster. When the economy is in a down, real estate is something which gets badly affected. So those are the firms which are cyclical. They are affected by the business cycle. Business cycles are nothing but booms and recessions. Whereas some industry, let's say food industry, liquor industry, these kind of industries, they are never affected by any kind of recessions. If that's the case, I'll look at them in a different manner. For them, I can apply a constant growth or probably phenomenal growth. Probably food, I can look at it as a constant growth, but liquor, I can look at it as a phenomenal growth kind of an industry. So based on that, I can look at the valuation of each of these industries. Right? But the biggest problem is the estimates are very sensitive to the inputs. Whatever D1 by KE minus G, if G changes from 5% to 4%, my intrinsic value gets damaged very badly. So the more accurate my numbers are coming, the more closer I am coming to my estimates will be closer to the accurates. The more sophisticated model I am using for forecasting all these things, the more confident I am about these forecasts, the more closer are my estimates to the actual. So that is what is the big challenge as we go with the DCF. Because DCF is like find the original value, not in comparison with something. Probably the best example I can give in this case is the HR's case again. Easy to understand for everyone. The HR, when you are joining a job, when you are applying for a new job, the first thing the HR asks you is what is your previous salary. Why do they ask that? The reality for me, according to me, is you pay this person as per his real worth. Don't look at what is his previous salary, blah, blah, blah. When I am saying pay the person as per his real worth, there could be different models. But assessing that kind of a real worth of the person is very, very difficult. You need to have a big process in place. How do I assess the real worth of the person? I should not ask about his previous salaries, nothing. Decide the salary for the person. That's a very difficult exercise. So that is what is a DCF model. But most of the companies, what they do, what is your previous salary? They'll give 10% more than that or something when you are joining a new company. That's like your multiples based model. Only comparison, giving you slightly more than that so that you are happy. So if that guy is already got his first salary much higher, probably the next salaries are going higher and higher only. But if the first salary is much bad, he is taking so much of a time to get his salary increased. Because HR typically goes with a comparison kind of an approach itself rather than the intrinsic value approach. But as we are understanding, the intrinsic value approach is a very complex process. How do I find out the real value of this person? Right? How much is worth to pay him without considering anything else? The more I am able to do that, I am using my DCF model very effectively. Anything we buy, let's say we are buying a TV. What is the base we use to buy a TV? Why is Sony more than Samsung? Or probably we'll always do a comparison approach. But rather than that, if I say based on the real features of the TV, real benefit which I derive out of the TV, this is the worth I will pay to it. Very few people look at it that way. Right? Probably, yes, this is the picture tube. This picture tube is worth this much. This sound controls are worth this much. Based on that, I am paying this much. None of us will do such kind of evaluation. One, because the knowledge we have in all those areas is very limited. Probably we'll have a good knowledge in our area, but not in all the varied areas. So obviously the best thing which we do is the comparative kind of an approach. Same thing is happening here also. The more I understand the business of the company, the more I look at usage of the DCF model, because my estimates will go much better and better. But if I don't have that kind of an understanding about the business and the industry, I'll always prefer a comparative pricing approach. This is more than the others, this is less than the others. A lot of places we follow such kind of mechanisms only. Right? So that's where on the price multiples kind of a front, they are widely used by analysts because, or probably brokers I should call. Even at a sub-analyst level, sub-broker level, they are very widely used because it's just a simple calculation. No, I don't need to forecast anything, right? Whereas in this case, I have to forecast all the future cash flows and all that stuff. Here I don't need any forecast, only two numbers, one in the numerator, one in the denominator. That's it. And the same exercise for multiple companies in the industry so that I can take a comparative approach. But as I said, if all of them are hyped, I am only doing a comparison between the two hyped ones rather than looking at the whole thing as a bundle. But yeah, it is used because it helps me in taking quick decisions. On the disadvantage side, again, may not be comparable across the firms. Because in one industry, all the companies may be hyped up. In one industry, all the companies may be hyped down. Right? So I cannot compare these two companies like this. So that is what will create a problem. Only within the industry I can do comparisons and say this is overvalued compared to this is undervalued compared to this. And this is not appropriate when the economic conditions change drastically. Because in recession I'll see all PEs will fall. In boom I see all PEs will go up. So I cannot talk about this should be the ideal PE for these kind of companies. Because as an industry, there would be a bulk growth or a bulk fall. Right? So, from those standpoint, it becomes very difficult to apply either the P by E or P by E, any kind of multiples kind of ratios compared to the intrinsic value based. And asset based, they are very much reliable, but we don't value the business in that case. Probably with this small asset, I may put it to use in a much better way, whereas you may put it to use in a much worse way. In using DCF, how much well I am able to utilize this asset will generate a higher value for the company. Whereas if I am using the asset very poorly, it will generate a less value for the company. But when I am going with the asset based valuation, whether I am putting it to a good use or a bad use, both of them will generate the same value for this company. So easy to calculate because I can find out what are the value of each of these things. And especially when there is no market for these assets, it becomes difficult to get the market value. Right? And if I am putting it to a better use, I am actually losing out on the value because the same asset, I am doing a very good usage of it, putting it to multiple usage. Let's say the same person, one company may use him to the fullest usage, the other company may not utilize him at all. But he is receiving let's say the same salary. So if I am going with an asset based valuation, he will receive the same salary, even whatever is the usage he is put to. But if we are talking about intrinsic value, because he has been put to a good use, probably he can gain for a very additional increment in the salary. Right? Whereas the disadvantages, as we talked about, especially in case of a very inflation economy, the asset price will just go up because even without any utilization on that. Because if let's say the inflation in the country is 30%, 40%, next year the computer prices may be much, much higher without any use being put into it. So the asset based valuations models will be completely distracting the utilization of that asset, especially in case of very high inflation kind of economies. In those cases, it's not good to apply asset based valuation model because unnecessarily you will get overvaluation and you may have to pay heavily for that.